Hello, I am Andrew Metrick, a professor of finance here at the Yale School of Management and the director of the Yale Program on Financial Stability. And I am delighted to be sitting here today with my good friend Paul Tucker, who is currently a research fellow at the Kennedy School at Harvard University, and before that was for many years a senior official, ultimately deputy governor for financial stability at the Bank of England during the financial crisis. Specifically, we're here today because ever since the failure of Silicon Valley Bank and what followed that failure in 2023, there's been a lot of debate in policy circles and academic circles about the right way for central banks, particularly in the United States, where we had the problem, to organize their lender of last resort function, their emergency lending, which is the original reason that we created the Federal Reserve in the United States, was to have that function. And it's a key function of central banks around the world that was invented, really, by the Bank of England. We've had a lot of debate about the right way to organize that and the way that that should be structured and made consistent with and congruent to the way that we regulate banks and supervise banks overall. Now, as it happens, Paul Tucker has been thinking about these issues and writing about these issues for decades, not just starting a year ago when the rest of us really started to take it very seriously. And along with his Bank of England colleague, Mervyn King, recently came out with a proposal that has gotten a lot of attention throughout the world. We just summarize, as a shorthand, we call it Tucker-King, the Tucker-King proposal. There's some differences in the way that Mervyn King and Paul Tucker think about the issue, but broadly, it's the Tucker-King. And what we want to do today is get a sense from Paul about what that proposal is, what its strengths would be, the problems that it would solve, the things that it wouldn't solve, and then take that into a discussion perhaps of how we could apply it very specifically here in the United States. So with that introduction, Paul, thank you very much for joining today.
Thanks for giving me the opportunity to talk about this. It's really great, Andrew.
This is really going to be terrific. So let me just start by asking you, all right, we're calling it Tucker-King. For someone who knows what a lender of last resort is and understands that that's something central banks do, what specifically is in your proposal that would be different from the way that we currently do things in the world?
The proposal that Mervyn King and I have separately outlined is that every bank, and actually more broadly even every financial intermediary with short-term runnable liabilities, would have to pre-position with their central bank sufficient collateral that after its discounted value would cover the entirety of their short-term liabilities. So that would mean it would have a number of effects, just sketching them very quickly. One would be that in advance, the central bank would know what collateral it would have to lend against. It would have been able to value that collateral, revalue it each day, ensure that it could understand that collateral. There would also be no question of a bank running out of eligible collateral during a run. And that last thing is pretty big, I think. But that's the proposal in its kind of raw form. And I think it would have been relevant to SVB, but I think it would also have been relevant for the failure of Credit Suisse in Europe last spring. And in some respects, I think the failure of Credit Suisse is even more significant for the United States than the failure of SVB. Looking back to the financial crisis in 07, 08, I think it would have changed things enormously then as well.
So let's take by way of example, let's start with Silicon Valley Bank, since I started by mentioning that. It seems like actually your proposal, a main value of it in the case of Silicon Valley Bank is they simply would not have had enough collateral in advance for some time before they actually got into trouble. They wouldn't have had enough collateral, and it would have been a mechanism to force the regulators to tell them you're not in compliance as early as 2022, when their bond portfolio fell a lot in value. It seems like it would have the ability to prevent runs before they ever got started, in addition to being there for the run itself.
The central bank would spot the problem, the weakness, a lot earlier.
Yes.
So imagine some years before the Silicon Valley Bank problem develops, they are prepositioning collateral with the Federal Reserve. And let's say it is all treasury bonds. And that at the beginning, the market value of those treasury bonds, after the haircut, whatever haircut the Fed is going to require, more than covers the entirety of the short-term liabilities. And then every day, and in fast markets, more than once a day, the staff of the central bank would mark the collateral and decide whether they need more. And as the yield curve starts to move up, before it's moved up a long way, the Federal Reserve is calling for more collateral because the value of what they're covering relative to the short-term liabilities is falling. And I'm going to assert, but I believe this, that it doesn't take too long for the staff of the Federal Reserve to say, actually, if the yield curve moves up much further, are they going to have enough collateral to cover all these short-term liabilities? We need to have a conversation with them. The supervisors need to have a conversation with them about what their book is like. And the key thing here, I think, is that at present, supervision, including monitoring compliance with regulatory requirements, but going beyond that, is a kind of periodic activity, quarterly, or less frequently from that. I've just made it daily, and I've moved it from being something slightly ethereal that is recognizable as regulation to something very operational. You know, this is run by smart people in the operational side of the central bank. That we can come to this later, but in many respects, I think that collateral management under the scheme I'm describing, and that Mervyn has also proposed, becomes to financial stability policy what interest rate setting is to monetary policy. And I think that's quite a thing. And when the bank says, we haven't got a problem, they say, well, actually, it's the third time this week we've asked you for a top-up collateral. You're going to have to satisfy us. And there's something much more tangible about that. I mean, my central banking career is more than a decade ago now, but I can remember situations where the kind of conversation that banks have with the operational people is much more hands-on. You've kind of moved it from the mezzanine level, which is where prudential supervision happens, to high policy, if you like, where I ended up, and ground level operations, which is exactly what the implementation of monetary policy is like. And I like that.
So, do you have a sense for how this would have played out for Credit Suisse? You talked about that as very important. That's an example of a bank where, to the best of my knowledge, it was not balance sheet accounting insolvent at the time that it ended up being resolved. So how would this process have helped or hindered in the case of Credit Suisse?
Let me say two things to start with, just by way of introduction on that. I think this is massive, by the way, and I think that the demise of Credit Suisse ought to be causing sleepless nights in the Fed and the ECB and the Bank of England in ways that I don't actually think about SVB. I think the lessons from SVB are obvious. The first thing to say is, on the information that is available to us all at present, it looks, yes, as though Credit Suisse was balance sheet solvent in the narrow sense that if it had gone into runoff, then in slow motion, maybe it could have met all of its liabilities. So that would have been the demise of Credit Suisse, but in a different way, a kind of conservatorship. And I just as an aside, when people talk about, well, why wasn't Credit Suisse resolved? If what I've just said is true, bailing in the bonds pushes up the equity, but doesn't actually deal with the franchise problem and the reputational risk problems that they had, which I think were the trigger for people to withdraw their custom and therefore withdraw their funds. Okay, so that may be wrong, but let's maintain the assumption that it was balance sheet solvent and could have gone into solvent runoff. But there's this massive run. And during the run, we know this from public statements that the Swiss National Bank have made, a succession of statements. They had a policy at the time of kind of mainly lending or lending mainly against Swiss mortgages. And then the run was bigger than the portfolio of Swiss mortgages held by Credit Suisse in Switzerland. And it seems that the Swiss National Bank didn't want to lend against other things and instead got a guarantee from the Swiss government for the central bank to lend unsecured.
Can I ask you, so under the framing you just gave, and I recognize we're working off of imperfect information, it's quite possible that they would have had sufficient collateral had your proposal been implemented a long time before and they had been prepositioning things. It's possible that the Swiss bank might have decided there was sufficient collateral there and they would have known. But in the moment, they weren't going to take some new collateral.
No, that's not what I think, actually.
Okay.
I think it is possible that had they been implementing the policy I've described, they would have discovered some years before that Credit Suisse simply didn't have enough collateral of a kind that they would ever want to take.
I see.
Now, but let me give the same answer in slow motion. So, if I may say so, Andrew's question is great, because one possibility, but the possibility I'm rejecting, one possibility is the Swiss National Bank just had too narrow a list of eligible collateral, and that if they'd faced up to this earlier, as they would have had to under the policy we're discussing, they would have realized that they needed a wider class of eligible collateral, and that would have been sufficient because they would have prepared in advance. Possibly in the Credit Suisse case, although I'm going to say no, but certainly in other cases, that would happen. Central banks would discover that their eligible collateral list was too narrow. The Bank of England discovered this in 2007 and didn't really fix it until during 2008. So I think the thought that you're having is not only a valid but a really important thought about the benefits of this policy.
But it's not the whole story for Credit Suisse.
I think not.
Yep.
I think not. And even if I'm wrong about Credit Suisse, what I'm going to say certainly could apply in some other cases, which would be, I'm the central banker, I'm going to make you the bank, and you want to borrow from me soon, and I say, what collateral have you got other than these mortgages and government bonds? And you say, well, I'm running a private bank, and I've got lots of loans to business tycoons secured on their business. I'm basically liquefying their private business. I've also got lots of loans of kind of super luxury goods, which, maybe funding yachts, which are really ships, secured on the ships, which may be owned in an offshore financial center and registered under a foreign flag and moored somewhere else. And the point is, in the first case, there's wrong-way risk. The circumstances that your customer defaults on you are the circumstances that the collateral behind it is worthless because their tycoonery business has failed. And the second case is, hold on, the customer's defaulted on you, the bank, have defaulted on me, and I've now got to go and collect these ships, which are owned by vehicles in an offshore financial center, and all the contracts are under foreign law, and I'm going to have to collect it. And when I was a central banker, what I used to say to the team, and in fact this became Bank of England policy, that the limit on what we should be able to take, willing to take, is we need to be able to understand it, and we need to be able to manage it when we hold it outright. That the reason we're taking collateral is because there could be defaults at two levels, and ultimately we're holding assets outright and need to collect. Now, a bank that has got is offering up assets that you wouldn't be able to collect or have wrong-way risk, these aren't assets that you want to lend against. So now go back to the benefits of the policy, and this may be true in the Credit Suisse case, that years before, the central bank says, well, actually, given your business model, you're never going to have assets that even if we're even if our eligible collateral list is as broad as the Federal Reserve's or the Bank of England's, which is very broad now, you're never going to have enough collateral for us to lend into a run that extends to the whole of your short-term liabilities. So, and this is the punchline, I think, so either you need to fund more of your asset base with longer-term funds, either equity or bonds, or if you insist on funding yourself in the short-term markets, your asset base has got to change, and your business model has got to change. And I think that even if this turns out, when we know more, not to be completely true of Credit Suisse, I think Credit Suisse should alert the central bank community and to the central bank watching community of something it's never really thought about, which is that a central bank can be completely generous in its collateral policy and still face circumstances where I'm not taking that because I won't be able to collect on it, or it'll be worthless in the circumstances we're contemplating, and the business model has to change.
Okay, so you've just explained it in a way that I think I now understand the ideas better than I did before, and I thought I understood them before. I would summarize it as being, we might want to write down a rule that says you're limited in how much runnable liabilities you're allowed to take by the willingness of the central bank to say this is how much collateral we're willing to accept from you, properly haircut. And this operationalizes that rule.
Yes.
Right? If you have this rule in place and we do it like this, the central bank is saying, here's how much we're willing to ever take from you. You may not, long-term assets, you may not have runnable liabilities beyond that. Okay, that's it's a nice thing to be able to say, here's a rule I would like, and then to immediately be able to say, here's how I'd operationalize it. And I think that your proposal does that. Now, let me ask you, years ago, when I worked briefly for the government, I worked for, among many other people, a good friend of yours, Larry Summers. And Larry Summers, when you would bring him a policy proposal, would say, okay, give me the best argument against it. What would you say if Larry asked you that question?
I'm not sure this quite meets the challenge, but an intermediate step, what I'm thinking, is we go through the discovery process. Actually, what we've just been discussing is like a mechanism for revealing the state of the bank. It's like a mechanism design idea in that respect. And we discover it, but actually we don't insist on an adjustment in the business model. I think that's actually beyond the spirit of Larry's question, but very pertinent. I mean, I think about SVB. This is a sweeping statement, Andrew, but I think there are relatively few lessons from SVB about policy other than it's a good idea to implement your policies. In other words, I think, unlike Credit Suisse, I think the SVB episode is about moral hazard within the official sector. We're used to talking about moral hazard in the banking sector, and that's the starting place, but we need authorities that are actually committed to their own policies. And I think the US just kind of completely failed in that respect around large regional banks. And as you know, that when I chaired the SRC, not because of me, but we pointed that out to both the Fed and to the FDIC. What else would meet? So a second attempt, which I think gets closer to the bone, is that it's sometimes claimed that this policy I'm kind of promoting is so brilliant that you wouldn't actually need any resolution regime at all because banks could never go bust because you'd always meet the run. And I don't think that's right. I don't think that's right because you could imagine circumstances where the simplest example would be all the collateral is kept in a safe and the collateral has been stolen from the bank's safe. And actually, no, let me set it up more carefully. So imagine we've got a bank with equity and short-term liabilities, and that's all. And maybe long-term bonds as well. And the central bank does its thing with prepositioning, but the bank is free to invest in other stuff to use its equity, not just to fund the haircuts, but that's why I said long-term bonds, but to hold other assets as well. And the documents for those assets are all in the safe, but they've been stolen. And the value of them was greater than the value of the equity. And the bank is bust. It is balance sheet solvent bust. And you were kind enough here with the journal you run to publish a paper of mine a few years ago on this, that in circumstances where the bank is fundamentally bust, the lender of last resort, the central bank lender of last resort, should not lend because it is making short-term creditors better off than equally ranked longer-term creditors. So it is not a complete solution to everything. You still need bankruptcy regimes. You still need resolution regimes. I guess a third possibility is, this is a variant of the moral hazard one maybe, is that as the crisis approaches, the central bank starts overvaluing the collateral. And the more liquid collateral, the more it's got leeway to do that. So it shades the valuations so as to relax the constraint on the banks. I think that requires some checks and balances around that. I don't think that's a kind of bullseye. A closer one, perhaps, and then I will, of course, I'm trying to pass this essay that your friend of mine, Larry's setting.
Yes.
But the fourth one would be, well, you do this for banks.
It's impossible to pass his.
No, I understand. The fourth one would be, you do this to banks, well, all the juicy stuff just moves out of banking into what I'm going to call shadow banking. And actually, this merely accelerates that trend. And the fragilities that are inherent to banking and the social costs of those fragilities crystallizing are just moved beyond the regulatory perimeter. And I think my response to that is yes. But that merely is another variant of the problem that has been understood since 2010-11, that Basel-style re-regulation, Dodd-Frank-style re-regulation of banks will create an issue about shadow banking and ought to be tackled.
Right.
So of course, I mean, Larry would actually himself come up with something better, but I've had 4 attempts.
Well, that's why he asks the proposer to do it. Okay, so haven't said yet, but in this talk, but as you know, and perhaps I hope for people who are watching at some point they will all know that in part because of the forcefulness that you and Mervyn have had in putting this forward, and in part because it became clear that this was a very topical issue after SVB. In the United States, the Federal Reserve is seriously considering taking a step towards a regime where they're actually using the words prepositioning of collateral now much more. You would never hear that before, and it is public information that they are considering a rulemaking process to have banks not go all the way towards what we call the full Tucker King, but to take some steps towards prepositioning properly marked collateral against at least some portion of their runnable liabilities. They're focused now on uninsured deposits, but that could broaden. Yeah. So the policy discussions are now getting quite concrete, as in like just how much prepositioning do you need to have, how will we do the haircuts, things like that. And so I wanted to just get some of your reactions to some of the things that are floating around and some of the debates that we're having here in the policy community in the United States, understanding that your proposal is really quite global and principled. Now we're in the nitty-gritty of what can we actually accomplish.
Yes.
Okay, so with that in mind, one of the things, so in your proposal you have the marking happening at a fairly high frequency, and as we've been told, at least the operations in the United States, they do mark at a fairly high frequency. They can, I'm sure, do it, put more person power on that job, but they're doing it daily. They do it they do it right now for anybody who has anything at the window. They can do it for things that are prepositioned. And so that's a possible thing. It does, however, raise the question, and one of the things that's come up in the debate a lot is, all right, well, suppose Monday morning we wake up and the world is just closed because of COVID. We've announced closures of everything because of COVID. So we're back in March 2020. Yeah. That announcement was Friday afternoon. It's now Monday morning. Realistically, anybody trying to market whole swaths of assets and loans and things like that, realistically, should lower their marks. And uncertainty has gone up, so they should probably raise their haircuts. So if we were behaving in any way as though we really were like a private sector actor worried about this, a lot of banks, properly marked, who may have seemed like they had a lot of room a few days ago, suddenly have to come up with more collateral at kind of maybe the wrong time for the government to be telling the banking sector you're in trouble.
Yes.
So how would we, is there discretion here? And of course, I just gave a case that might have seemed impossible 10 years ago, but now know is possible. But little pockets of this could be happening a lot. Do we want to be saying, all right, we're shutting a bank down because it was a bad weekend and market prices have fallen, even though we know that might be not necessarily a hold to maturity, patient government way of thinking?
So this goes to haircut policy, and where haircut policy becomes a really big thing. So there's eligible collateral policy and there's haircut policy. So the first thing to be said about haircut policy is the haircut I want depends upon what I think my realization period is. Second thing to be said about it, that helps address your question. The second thing to be said about it, and actually this is true in normal circumstances and probably true for a lot of commercial players as well, the valuation of your asset, but even more importantly, of your collateral asset, and even more the haircut, it only matters in bad states of the world where there are defaults. So this is really, really important. Mm-hmm. Collateral, in a sense, is of no interest whatsoever, except when people are defaulting. Right. If you have systemic institutions, by which I mean institutions that will be systemic in any state of the world, smaller institutions can be systemic in some states of the world. But for systemic institutions, systemic in any state of the world, you need to think about what haircuts you will need, which is a judgment, in circumstances of systemic distress, not not how it looks during the lovely little boom before the bubble pops. So I think that points in the direction of haircuts being kind of fatter than lots of people would expect. And by the way, we should come back to this. There's a very important thing which I alluded to in passing. How do haircuts get funded? They plainly can't be. How do the extra collateral meeting haircuts get funded? Equity and long-term bonds. So so in a sense, haircut policy drives capital policy.
Right.
But the second point about the realization horizon matters, I think, in the circumstances you describe. Let me get there in 2 steps. First of all, if I lend against loan portfolios, then it would be silly to think that I could possibly liquidate or realize the value of a loan portfolio in a day. So I'm going to set a longer horizon for that, somewhere between mark-to-market value in the market and a kind of fundamental value. By the way, I'm now describing things that the Bank of England did during the financial
So are you,
crisis.
just a clarification question. So there's valuation policy and there's haircut policy.
Yes.
Sounds like what you're talking about now is like the valuation part of it, which then drives what my initial haircut might have been.
Yes, exactly.
Okay.
Exactly. That's right. That's right. And you're right to make that clarification. And actually, a problem for the central bank and therefore for the wider society can arise either because haircuts were too low or because valuations were too rich. And one of the good things that happened to the Bank of England during the global financial crisis is that we had been very transparent about how we set haircuts and what they were and all of that. And people, including former central bankers and economist Willem Buiter, who was here once upon a time in Yale, said, yeah, that's all very well, okay, but how are you valuing this stuff? And we kind of, internally we said, well, actually, that's a reasonable point, kind of slightly irritating, but reasonable point. We better publish something on how we're valuing collateral. And I don't think central banks do enough of that. So that was concentrating on a loan portfolio. But your point about it is where you started. That's valid for treasury bonds as well. But in those circumstances, you wake up on Monday morning and you could say, well, actually, the period, the realization period, a day doesn't make sense. Perhaps. I'll come back to the perhaps. Actually, we should be setting haircuts and making margin calls and doing our valuations on a kind of slightly longer term horizon, 5 days or 10 days or whatever. Where this matters, it matters a lot whether you think the collapse in the market value of treasuries is driven by the revelation of some fundamental news about treasuries, there's sovereign risk or something, which that can definitely happen, or whether actually there is a liquidity crisis in the market itself, which can be cured, or alleviated at least, by a market maker of last resort operation. I mean, there's a kind of paradox here, that in circumstances, what are commercial banks doing? They're providing private liquidity insurance to the rest of the economy. That marking everything in a market liquidity crisis that is not a fundamentals crisis in a way that drives them into insolvency is perverse. But you do, in those circumstances, just need to make a judgment, a careful judgment, about whether this is a fundamental shock to the value of treasuries. They're just going to be worth less now. Or alternatively, a kind of an ephemeral problem because of market liquidity conditions. But I would say that a merit of the policy that I've been proposing and Mervyn's proposing is it makes the central bankers confront these questions and think about them in advance. I mean, one of the when we went through the private banking example, where it turns out there just isn't ever going to be enough stuff, I think this made me think about this policy in a slightly new way. The most obvious thought about the policy is that's good. When you have the crisis, you'll have the stuff. But the other part of it is the process of trying to implement the policy reveals you're never going to have enough stuff. And I think my answer to your challenge, which is we wake up on Monday morning and the world's different, is yeah, and you have to think about that in advance, and it has to be reflected in how you value things, what the haircuts are, and how you would change your valuations or your valuation method in certain extraordinary states of the world. And the thing I want to underline is, just like monetary policy. If monetary policy has improved since the 90s, which even after the arguable mistakes of recent years, it is still improved since the 80s and 90s, it's because a lot more is thought through in advance. The reaction function has become richer and more multidimensional. And I want that to happen in this stuff.
Yes, it is. I mean, it really is were one to implement this policy, it would be a structural change in what it would mean to be a bank. And for the allowable for how the business model of any specific financial intermediary would have to be constrained by this relationship between runnable liabilities and acceptable assets as collateral.
Yes.
And that's just not on the table at all now. Now we have specific rules about different things without ever quantifying that relationship.
I mean, up to a point, this is a bit too sweeping, but up to a point, the so-called liquidity coverage ratio goes away. I'm not quite sure about that.
Capital requirements go
capital
away.
requirements.
Yes.
Well, capital requirements become haircut
They
policy.
become implicit in the haircut.
Yes.
And so let me follow up on that actually, because I think that's another place where when we've had our discussions that have included policymakers and people from industry, first thing that comes up is, okay, when we start putting numbers on this, we say, suppose we're doing the valuation, let's imagine just for the moment that we're able to value things starting on day zero perfectly. So they're perfectly valued. But of course, we're going to have some haircuts that are going to be in place to keep us safe.
For bad states of the world.
For bad states of the world. Okay, those haircuts, whatever number we pick, is the analog for the headline capital ratio number.
Yeah.
The headline number that we used to call the capital ratio of just sort of equity over assets.
Equity plus long-term bonds.
Equity plus long-term bonds. Okay,
Yeah.
so we start with that headline number. Now, what we do know is that when we fool around with that number, that haircut number, when we fool around with that capital number to banks now, you would think that we were, making ice cream and candy illegal, right? So what goes on right now in the United States, we're still engaged in what we call Basel Endgame, where they're talking about a few percentage points of additional capital. And to listen to the banking industry talk about it, this will be the end of Western civilization. So I wonder if it's possible for us, and here, for people who are listening and don't know, I'm talking to an expert in political economy and the constraints of delegated authority. For a delegated authority at a central bank to effectively, by changing their haircut policy, change the capital policy outside of any kind of legislative review or outside of any kind of input from the public. In principle, they could change their haircut policy if we had a different administration in place. This is another thing we sometimes hear.
Yes.
They could say, okay, from now on, everything having to do with green energy has a haircut of 50%. Or has a haircut of 0 because it's part of industrial policy. Do you think, now putting on your hat as a political theorist, is this a sustainable place for a delegated authority like a central bank to be?
So These are profound questions. The first thing to say
Well, you have a few minutes.
is no one cares about stability until they're screaming for help. I mean, let me repeat. No one cares about stability until they are screaming for help. And this is quite an experience to be on the end of the other end. One doesn't ever think any less of the people concerned at all. But it is, in terms of a mechanism of political information revelation, it is enormous. That's the first thing to say. The second thing to say is, I liked your turn of phrase, which is, they're claiming civilization will end. Well. The thing that might jeopardize our civilization, our liberal democratic way of life, is another banking crisis.
Well, the last one's not done working on us yet.
So who benefited most from the collapse of Western banking in 2007 through to very early 2009? Beijing. And, a lot of people, and I think this can be overstated, but a lot of people believe that Beijing became more assertive after the global financial crisis. I mean, in my most recent book, Global Discord, when I reach kind of finance and economics, one of the things I stress is the West cannot afford another financial crisis. I mean, I think the significance of SVB here is not in terms of policy lessons as such. It's that. Mm-hmm. It's how could people have thought. This isn't a world where there isn't a competitor out there. I think the third thing to say is that some people, perhaps not all of the voices that are opposing the finalization of Basel III, said that what was introduced from 2012 onwards would be a disaster for banks. Well, it doesn't really look as though it's worked out that way at all. It's not obvious that's what's been holding back the American economy is lack of credit supply over recent years. There are lots of other problems, but then your political economy problem, which I agree with. So, the first thing to say is this is a rather general thing, is I think the economics profession thought much more about commitment problems and what that meant for the design of regimes in the monetary sphere than in the financial stability sphere. And I think that's a real problem. The great papers, Kidlin, Prescott, Barrett-Gordon, Rogoff, Walsh, where are the equivalents for financial stability? And it doesn't matter whether it's technically a time and consistency problem, although I think there is one, or a kind of a commitment problem that is to do with changing objectives. I think we badly need that literature, and I've been a bit surprised that the central banking community hasn't pushed the academic community to writing those papers through the holding of conferences. And actually, I worry a bit that economics has, moves forward. That's brilliant. That writing those papers in financial stability isn't incentive compatible for PhD students, young professors, or even established professors, because this isn't going to demonstrate some new technique in new thought in the way that Kidlin and Prescott did, and it won them the Nobel Prize. But that's why central bankers should be promoting it and holding conferences to do that. The reason I say that is not just because I think that would be useful intellectually. It's that the political economy problem to delegating monetary policy, how to overcome those problems, was illuminated by that literature. But also perhaps this isn't an also, it's partly by giving central bankers and treasury ministers ways of framing the problem to elected politicians in a way that helped. I mean, I can remember a world in which in Europe, certainly in Britain, certainly in France, most elected ministers were not sympathetic to monetary policy independence. But the intellectual climate changed in slow motion, and I would say the same could happen here, in that the costs of financial crises are so great. And in this country, of all the rich democratic countries, this country has zero appetite for disorderly bank failures. I mean, that we saw this with the regional banks. You can almost feel the executive branch pressure for, we can't have a banking crisis this week, go and buy it, or go and put taxpayer resources behind it. And that really pisses people off. And I think that people like you, my successors, I think they need to find a way of, look, this is a choice between constrained discretion, has to be constrained, Ben Bernanke's expression for monetary policy, constrained discretion will actually save you the much worse political problem of the extreme moral hazard where the taxpayer comes in and just bails these people out. I don't think that's a fully adequate answer to your challenge, but I think it's doable. I don't think the work is currently going on that will help that process as much as could be.
Well, I agree with that, but I thank you for pushing it, because I do think that there's a lot more going on than there used to be. Yeah. We could certainly go for several more hours, but I promised you I wouldn't do that. So I want to give you an opportunity. Is there a major topic that you would have liked to address today, but I didn't manage to get to?
I'd say two things very quickly. If I may, Andrew, the first is what I'm describing and proposing would actually change central banks as organizations. That, the monetary policy team is an elite set in the central bank. I mean, I became part of it. I mean, before I was a policymaker, wow, that's still how I think about my previous career. Collateral policy should be the same. Something that Mervyn King was fantastically supportive of this from 2008 onwards. When we started broadening our collateral that we would take, I said, I need a really crack team to do this. Can I have the following people? And he basically just said yes. And it became an elite thing. And I want to tell one story from that. I'm not going to name the individuals or the bank. So we were lending against securitizations of UK prime mortgages in one of the early 2008 facilities, one that helped but not helped enough. And this bank brings a portfolio, and the team go through it, and the head of that team, who's now very senior in the Bank of England, comes to see me. She just walks in, and she says, so these are meant to be UK prime mortgage securitizations. There are loans to the operators of Spanish car parks in there. So earlier I was, in terms of this revelation principle, we were at kind of a very grand level indeed. But actually it can be quite in the weeds. But the bank either didn't know or did know. Doesn't matter. The final thing I would say, and we won't have time to discuss it, is there are international liaison things here. It's in Credit Suisse's case, it needed some dollars as well as Swiss francs. And so, quite how you divvy that up is a separate set of questions. But ultimately, you as the lender of last resort, you ultimately need to be able to cover a run that doesn't stop. And final notes, occasionally it's suggested if you had this policy, it's so marvelous that it would prevent runs because the run could be handled. I don't think that's true. It might reduce the incidence of runs, but I don't think that's the key thing. I think the key thing is that that you can handle it.
Well, thanks a lot, Paul. This has really been terrific, and thanks for helping to move this debate along around the world, but specifically here in the United States, where it's been tremendously helpful.
Well, thank you, Andrew, and it's such a relief to old lags like me that people like you, and actually, above all, you personally, have taken an interest in these issues for so long now. It means a lot to those of us who either are policymakers or who've, like me, been policymakers. So thank you very much, and for what your center does.
Thank you, Paul, and thanks a lot.